Hello everyone, welcome again. We will continue with corporation tax. Now we'll look at some other important aspects of corporation tax. I will just share the screen with you quickly. And before I share the screen, could you please note down this question which I have listed on the whiteboard. This is a small example which I've just made up with the help of some BPP text, and made some additions to it. It is enhanced capital allowances. I will just read it to you so that you can write down, because you might not be able to read it. It is a small size. Right, so it is Z Limited spends £100,000 on water saving plant and machinery in the year ended 31st of March 2017. Z Limited has trading losses of £500,000 for the year including enhanced capital allowances on water saving plant and machinery. Then it says a company's pay as you earn liabilities are £15,000 in the year, and requirement is how much first year tax credit can Z Limited claim. How much first year tax credit can Z Limited claim? Right then, so I'll just share the screen now so that we can read the notes, and then we'll try to do this example which I've listed on the board. If you could move to page number 82 of your lecture notes. I've already shared the screen with you anyway on the board, on the screen. Page number 82, enhanced capital allowances. Excuse me. Now, and one of the type of capital allowances, you know what the capital allowances are anyway. One of the type of capital allowance is enhanced capital allowance. So when you spend on water saving machinery, water saving plant and machinery, and energy saving plant and machinery, so if you spend on either of that, all of the amount which you spend on that can be claimed as enhanced capital allowances. Now, what was the function of capital allowance? You remember that we make the trading profit and then we deduct the capital allowances out of that. So it reduces our it reduces our trading profits. So we eventually had to pay less tax. So this enhanced capital allowance works in the same way like other capital allowances. So basically it is another type of capital allowance. So if your company or you spend on water saving plant and machinery or energy saving plant and machinery, then 100% of that will go towards the enhanced capital allowances, and it will reduce our costs as well. Right? However, as I said, that it will reduce our trading profit so that we can pay less tax. Sometimes what happens, the company is already in the losses. So if the company is already in the losses, so even if they claim whatever amount of capital allowances, they will eventually increase the loss, right? Because they are already in the losses. If we deduct the capital allowance out of the loss, so negative is positive. So basically it is going to be, it will increase the loss. So in them cases, HMRC says that instead of claiming a capital allowance, what you can get is 19% cash amount of whatever you have spent on enhanced capital allowances, right? So that's what we are going to study now, enhanced capital allowances. So expenditure on energy saving or water saving plant and machinery qualifies for 100% enhanced capital allowances, ECA. If company incur losses, it can claim what is known as first year tax credit. So when the company is in the loss, it can claim first year tax credit, where company can surrender tax losses attributable to enhanced capital allowances for cash payment instead of 100% enhanced capital allowances, right? So they will be eligible for cash payment instead of the enhanced capital allowances. However, the cash payment won't be 100% of ECA. It will be not 100% of ECA. It won't be 100% of the amount which you have spent on the plant and machinery. It will be 19% of the amount which you have spent on the plant and machinery, right? So first year tax credit is 19% of the loss surrendered, subject to a maximum of higher of total amount of pay and NIC for the period of loss and £250,000. Now, amount which we can get in cash from HMRC is 19% of whatever we have spent on plant and machinery. However, maximum we can get is higher of these two, which is total amount of PAYE and £250,000, right? So up to a maximum of these two, and maximum of which one? Higher of these two. So whichever is higher, up to that amount. So now if you read the question which I've listed on the board, that's why I asked you to write down, because we are in the shared screen mode, so you won't be able to see on the board now. However, I will read it from the board and you will read from your notebooks. So, enhanced capital allowances, Z Limited spends £100,000 on water saving plant and machinery in the year ended 31st March 2017. So they spend £100,000 on water saving plant and machinery. Then it says Z Limited is already in the loss, so 500,000, half a million is a loss. So it means that they can claim a first year tax credit. And in the requirement it says how much first year tax credit can Z Limited claim. So £100,000, we can claim 19% of that. £100,000 multiplied by 19%, it is going to be £19,000, right? So that is £19,000. However, maximum it can go up to how much? Up to total amount of pay and £250,000 higher of these two. In this question, it tells us that pay liabilities are £15,000. So, £15,000, so higher of £15,000 and £250,000. So higher of £15,000, which is pay, and £250,000. Which one is higher? You're right, £250,000 is higher. So we'll take £250,000. So is our first year tax credit higher than £250,000 or lower than that? Yeah, £19,000 is lower than £250,000 anyway. So we are eligible for £19,000 enhanced capital allowance in this question. Say for example, it was not £19,000, if it was £290,000, then we were restricted to £250,000 because it says up to a maximum of higher of these two, total amount of pay and £250,000, right? Another thing as well, say for example in this question, pay liabilities are £150,000, right? Say for example these are £350,000, then pay will be higher than £250,000, so higher will be £350,000 pay. So then this £19,000 again is less than pay £350,000 as well. So I mean, we can change a lot of things in these questions, so you can think about from all of these different perspective. So examiner can just swap the information and to confuse yourself. So basically rule will be exactly the same which you have just studied, however he can just increase or decrease the different stuff from the question. Anyway, let's move forward. Personal accountability of senior accounting officer of a large company. Now say for example if you are accountant in a large company. Now what does large company means? It says a turnover of £200 million and a balance sheet total of more than £2 billion. It is called a large company for these purposes. Then the company's senior accounting officer will have personal accountability for ensuring that financial system of the company are adequately maintained to accurately report taxable profits and gains of the company. So if you're a accountant in this company, senior accounting officer in this company, then you are personally accountable to ensure that the company is showing their profits right and the capital gains and all that. However, if you do not do that, you might face penalty of up to £5,000, and the company must notify HMRC the identity of the senior accounting officer. So whichever the company is, they must tell HMRC who is a senior accounting officer, so that if the accounting officer is playing up, then they can send him a check of £5,000, ticket of £5,000, not a check, sorry. So that will be a penalty. Anyway, group payment arrangements. Now say for example if your company is part of the group, and in that group many companies are paying the corporation tax by installments. Now if many companies are paying by installment, because they will have to account for the tax installment payment, and there will be a lot of administration involved, then what they can do is they can still say that company A will be our representative member. So company A will be paying installment of all of the group's installment, so only company A will pay. So it will reduce our administration, so it will reduce our cost as well. So that's what it says. Where more than one company in a group is liable to pay tax by installments, then the group of companies may make an arrangement for installment to be paid by one company, nominated company or representative company. Right? Our next topic is very, very important. If you just mark it as important, employee shareholder. It is important not only from a theoretical perspective, but it is also important from calculation as well, because examiner can examine calculations, and he has examined in one of the previous exam sittings. So what is employee shareholder? Now, if you're working for a company, if I'm working for Accounting Institute, they are paying me salary, they are paying me some other benefits as well. Now, what if the company says, my employer says that please do not take these benefits, although you will be getting the salary, but please do not take some of these benefits. Now, my boss will point out that this benefit, and this benefit. If you just do not take these benefits, I will give you shares in Accounting Institute. So if I agree, then I will be employee shareholder, because I am employee and I am shareholder as well. So what I will be doing, I will be dropping some of the benefits for the sake of shares in this company for which I am working. So that is called employee shareholder. However, there are a few conditions to be met. So let's see what these are. Employee shareholder is an employee who gives up certain employment rights like remuneration, unfair dismissal compensation, and statutory redundancy pay in exchange for employer company shares. The following conditions must be fulfilled. So these are the conditions which must be fulfilled. Only then it will be called employee shareholder. Employee and employer both agree, so there must be a contract between them. Employer must give a written statement that who is employee. Excuse me. Employer must give a written statement so that HMRC knows and other parties know that who are the people who are employee shareholders, because there will be lots of employees in the company. So in order to see that which one are the ones which are employee shareholders, so they will say Mr. Thomas is employee shareholder, Mr. Faisal is also employee shareholder, and like that. So they will have to tell that which ones are the employee shareholder. Employee must give employee at least 2,000 worth of shares. So 2,000 pounds worth of shares must be given at least, right? And these 2,000 pounds worth of shares employee won't have to pay anything. So these will be free shares. Employee won't be paying anything up to 2,000 pounds. However, if the employee gives, say for example, 3,000 pounds worth of shares, up to 2,000 pounds is exempt. Extra amount which is given, they might have to pay tax. Although they could be free, but I'm talking about from a tax perspective, which we'll see now. So, employer must give employee at least 2,000 pounds worth of shares. Employee will not pay for the shares. If employee obtains relevant advice from independent advisor, then its cost will be paid by the company. Now it says if employee obtains relevant advice. Now it is a must rule now. Employer must obtain advice from an expert, and if it is if the employee is going to take the advice from an expert that whether shall I take the shares in this company or I am better off keeping these benefits, so whatever the expert is saying, then obviously that employee will do that. However, when employee will go to the expert, he will be charging some money, won't he? So he won't be telling him for free. So whatever the price of that expert will be, employee won't be paying it. The company will be paying it, right? And then employee will have 7 days. Employee must wait for 7 days before taking decision of either to take the shares or to leave the shares. So employee will not pay for the shares. If employee obtains relevant advice from the independent advisor, then its cost will be paid by the company. Employee must wait for at least 7 days of taking advice before accepting or rejecting shares. If an employee accepts shares of the company as an employee shareholder employment, then there will be income tax charge. Then there will be income tax charge on employee if the employee holds less than 25% of the issued share capital. So if employee holds less than 25% shares, then there will be income tax charge. However, how will we calculate the income tax charge? Up to £2,000, there is nothing more than that. Whatever is excess, there will be, it will be considered as employment benefit, and you will have to pay income tax on that. So there will be income tax charge on the employee if employee holds less than 25% of the issued share capital in the company. The taxable employment benefit will be calculated as market value of the shares less £2,000. On disposal of the shares at gain, if you sell the shares and you make a gain, first £50,000 will be exempt, and on excess of that you will have to calculate the capital gains tax like we used to do in our normal cases. Now this £50,000, it is exempt. However, we are restricted to lifetime limit as well, which is double of that, £100,000. Then it says on disposal of shares at a loss, this loss will not be allowable. Right, so it was a employee shareholder. Now I will just show you a question on excuse me, on employee shareholder. Give me 1 second. As you can see on your screen, question number 22 of BPP exam kit. Question name is Claudia, and we've done one part of it already in one of the previous videos. We are going to do part A of this question now. Right, then there are three parts in part subparts in part A, so altogether 10 marks. So first one, 4 marks, explain what is meant by term employee shareholder and outline the conditions that must be satisfied for Claudia to be an employee shareholder. Now there are 4 marks altogether, and it is general information, very general information. So you just need to copy from the notes which we have just studied. It is exactly the same thing which we have just studied. So you have to tell him that what is employee shareholder. And you have to tell 3 conditions as well, because it is 4 mark requirement. So 1 mark for the definition, another 3 marks for the conditions. So just tell him 3 conditions, whatever the conditions are, which we have studied in our notes. In part A2 it says, assuming that Claudia takes up employment with Noble PLC and is issued with employee shareholder shares worth £5,000. Explain the income tax and national insurance consequences for Claudia of the issue of the shares. Now the shares are given for £5,000. Now up to £2,000 we know that we don't have to pay anything. Now excess of that, so 5,000 less 2,000, whatever the difference is, £3,000. For them £3,000, that will be considered as employment benefits, as we have seen in our notes. So you will have to include it in employment income, and you will have to pay income tax on that. It is also asking about national insurance consequences. Please remember, national insurance class 1 NI will only be payable if it is readily convertible cash. So if your asset, if your shares are very, very easy to sell, and when are the shares easy to sell? When they are listed on the stock exchange. So you'll have to read the question. If it is listed if the shares are listed on a stock exchange, then they are readily convertible into cash. So you will have to pay class 1 NI on them as well. So you'll have to read the question for that. And in the requirement number 3 it says, and it is worth 2 marks anyway, requirement A2 was only 2 marks. In the 3 section there, it is worth 4 marks. It says, state the capital gains tax consequences of the disposal of the Claudia of the employee shareholder shares in Noble PLC in the following circumstances: sale to an unconnected buyer, sale to an Nigel or whatever, and takeover of Noble PLC by TPLC, and Claudia receives shares in Token PLC in exchange for shares in Noble PLC. Now one is unconnected buyer. So if you sell the shares to unconnected buyer, what would happen? Now if you make a gain up to first £50,000, there won't be any capital gains tax. and on excess of that, you will have to calculate the capital gains tax in the normal way like you do, all right? Because it is employee shareholder shares, right? And in the second section, in the number 2, it says sale of shares to Nigel. Now we'll have to see who Nigel is, because first one was unconnected buyer. Let's see who is Nigel in the scenario. Claudia is married to Nigel and has one adult daughter, Johnny. So Nigel is a spouse, right? So when it is given to spouse, what we normally do was that for capital gains tax purposes, when you give it to your spouse, it is no gain, no pain, so there won't be any capital gains tax. Whatever the cost is, it will be sales proceeds, so it will be equal to the cost, right? That is the normal way to do it. However, because these are employee shareholder shares, so normal rules won't apply. The rules which we have discussed earlier, first £50,000 will be exempt, excess capital gains tax will be calculated in the normal way, so them rules will apply. Likewise, if you look at the number 3, it says takeover of Noble PLC. So if it is a takeover by one company, of another company, so we have studied the rules of reorganization and takeover, and we did one question as well on that, if you remember, in capital gains tax. Now, normal rules of reorganization and takeover, they won't apply here, because this is employee shareholder shares. So normal rules won't apply. The rules which we have studied earlier in the first section, them rules up to £50,000 is exempt, and on the excess of that, capital gains tax will be payable. Them rules will apply. So normal rule won't apply to this one. Right? So that's it for this video, and I will see you in the next video, and then we will continue with capital gains tax. All right? So thank you very much, and I will see you in the next video. Goodbye.